The risk on insurance bonds is the underlying investments that you choose to invest in. Then early access to the money could be a situation if you want to put the money in, draw it out under the 10 years, and then you're going to have to declare the income less the offset and pay tax on that. However, that can often be mitigated because you can transfer ownership of the bond to a lower taxpayer as long as you trust them, and they can give you the money after they've withdrawn and taken advantage of the 30% tax offset. So most people shouldn't have to pay tax on a withdrawal from an insurance bond. After 10 years, of course, it's all tax-free. In terms of overall returns inside insurance bonds, or inside Austock's imputation bond, we have 30 funds that people can choose to invest in. They are wholesale mainstream funds, and they give us a return. We then do a provision. We simply have great advantage there in so much as we don't have to sell an asset to take advantage of market downturns and get a tax write-off. We get that anyway. The tax provision remains invested until we absolutely have to pay it, so the client gets the advantage of that money still being invested. So overall, we do get usually far better than 30% tax returns inside the bond. The client can choose where they invest. We have a range of index funds, we have mainstream international fund, we have fixed interest funds, we have cash funds, we even have a tax-paid portfolio of term deposits for those who really want term deposits. So there's a whole range of investments there. So in terms of the overall return on the imputation bond, it's really going to depend how and where the advisor recommends they invest. We will do our best and use the rules to our advantage of the tax rules and so forth to actually maximise that return. But we've seen some very good figures over the years that we've been operating this bond.